I've owned Berkshire Hathaway for quite some time now, and I always thought Berkshire as a high quality compounding machine. It's a company that grew exponentially over the time I've owned it, and it's also been a company that significantly outperformed the market. I still think Berkshire is an extremely high quality company, and I still think Berkshire may have potential to outperform going forward. However, there's a couple main reasons I sold this company, and I'm going to explain why I sold it and what I bought to replace Berkshire in my portfolio. Now, just to get things straight, I'm going to point out that I do not think Berkshire is a bad company in any way, shape, or form. I think Berkshire is an extremely high quality company and will probably have potential to outperform going forward. Now, to understand why I sold Berkshire Hathaway, it's important to lay out the fundamentals of my investing strategy. It all comes down to these 3 points here: a strong moat, strong management, and a margin of safety. So does Berkshire Hathaway have a moat? And the answer is going to be an outstanding yes. Warren Buffett himself actually made popular the term moat in investing. Berkshire Hathaway has diversified revenue streams and stakes in high quality businesses. These businesses each have their own competitive advantage. Like they have BNSF, which is the railroads, they have manufacturing, they have Geico, which is insurance, and each of these businesses all have their own competitive advantage. So this just shows a breakdown of each of Warren Buffett's businesses in Berkshire Hathaway, and this actually shows how diversified this business really is. So you have BNSF, which is the railroad company, which is a very high barrier to entry company. You're not going to see upcoming companies come up and build railroads in America. These are companies that will probably be there for the next hundreds of years. And then you obviously have the energy sector, which is also very important. The demand for energy of AI and everything is also growing, so that's a big factor in Berkshire Hathaway. You have service and retailing, and then you have the McLean company, manufacturing, which is 25%, and then you obviously have the insurance business. So this is more of Geico and their other insurance businesses. So Berkshire Hathaway is a very diversified company, and this is not even showing their equity portfolio. So they do hold a large equity portfolio, and they actually have a bunch of cash on hand. They have over $350 billion of cash at this moment in 2025, which is insane. If they want to do an acquisition, if they want to acquire any small businesses, they could easily do that with this amount of cash. So to answer the question if Berkshire Hathaway has a moat, the answer is going to be an outstanding yes. Now we move on to management. So is the management of Berkshire Hathaway strong, and is the management of Berkshire Hathaway competent and understanding of the business? The best way to see if a company has strong management is to actually look at a few key metrics in the business. If we go over to FinChat and we look at the return on invested capital, which is one of the metrics I tend to use to actually judge if management is good at returning equity to the shareholder. And you could see Berkshire over the past 10 years has had some decent return on invested capital. I wouldn't say that this is the best return on invested capital I've seen. I know companies like Visa and MasterCard have a significantly higher return on invested capital, but as this company is in the insurance business, it is not a concern to have a slightly lower return on invested capital. So I would say they are pretty good in this sector. I also always look at the total shares outstanding, and the reason for this is to understand if the CEO is going to be doing buybacks or not, because buybacks are very important to return shareholder value. What I see here is in 2019, 2020, and 2021, Warren Buffett, the CEO, actually started doing some significant buybacks, which is very good to see. It means he saw the intrinsic value of the company go down, and as a result, bought back shares to benefit the shareholder. So that just shows that Warren Buffett obviously cares about the shareholders and wants to emphasize on shareholder value. They actually stopped doing buybacks currently in the last 3 years, and I believe the reason for this is Warren Buffett does not see value in doing buybacks at this moment in time, but that might change going forward. If he sees the share price go down and he thinks there's value, he might start doing buybacks again. So that's always good to see. What I'm going to look at now is if the revenue is increasing. The reason for this is to actually see if Berkshire Hathaway is a growing business and is continuously growing over time. As you can see on this graph, the revenue has been significantly increasing. However, it has slowed down. So you're going to notice that over the past 10 years, revenue has had a compound annual growth rate of around 6%. So around 6 to 7% is the current growth rate of Berkshire Hathaway. Now the share price has returned a lot more than that since then, but the revenue itself has only been increasing at around 6 to 7% per year, which is not necessarily a bad thing, but it just means that in the future they might have to innovate more and find new growth drivers. Now we get to their earning transcripts, and I want to point out what was said at the Berkshire Hathaway annual meeting this year, because there are some important points to understand with this business. The first being is that there's now a succession plan in place, because Warren Buffett has actually been the CEO for over 60 years. So that's an insane amount of time to be CEO, and obviously he's getting old and he wants to obviously have a successor in place, because when he's in his 90s now and he's getting quite old, and that creates a high risk for Berkshire shareholders, because if there's no succession in place, what's going to happen with the business? What Warren Buffett said is he actually appointed Greg Abel as the next CEO of Berkshire, which is good to see, and Abel seems to understand the business like Warren Buffett does, so it's quite nice to see that there's a good succession plan in place. And what I also find very important is that Warren Buffett always emphasizes on importance of trust and culture and integrity. I feel like as a CEO, you have to always have integrity and be honest with your shareholders, and in business in general. You can't be a dishonest person and own and run a business, because that business at some point will get into problems. So there's countless interviews on the internet where you have Warren Buffett talk about life experiences, and he talks about his experience in running a business. And I think that a lot of these clips that you see online of Warren Buffett talking, he's a very honest and very genuine person. Even though he's stepping down in the next year, hopefully Greg Abel will have the same mentality and the same view as Warren Buffett did. That's a very long way of saying that Berkshire's management is top of the line and extremely good. Now we get to the margin of safety with this business, or what I would like to consider valuation. Berkshire Hathaway has always been extremely difficult to find a valuation method for. Some people say to use price to book, some people say to use price to earnings. So people will tell you different things each time you try to evaluate Berkshire Hathaway, and there's no right answer to this question. Evaluation is based on your opinion, and it also depends on what you think this business will grow in the future. If you think the business will only grow 4% in the future, then you would probably use a different valuation method than someone who thinks the business is going to be growing 20% in the future and has exponential growth potential in new sectors. So it really depends on what evaluation method you're using and what you expect with the business. So there's no price point I could give you to what a fair value for this business is. It all depends on what your future growth prospects are, and it also depends on your own personal opinion and if you think the new CEO is going to find new growth drivers. So I'm just going to give you a bit of my opinion on this, and I'm going to use the evaluation method of price to book for this example. So price to book has always been around the 1.3 to 1.4 range. So as you can see here in 2021, it's been at 1.4, and the lowest point I actually got was in 2020 when it hit a significant low of 0.9, and this was actually when Warren Buffett was doing significant buybacks. But since then, up until now, the price to book ratio is at 1.7, which is the highest in the past 10 years. So me personally, I see that Warren Buffett has stopped doing buybacks, and I also see that the price to book ratio is at a 1.7, which is higher than it has been throughout recent history. So that tells me that this company might be slightly overvalued. This is a good segue into the point of why I sold Berkshire Hathaway. So I listed all the positives of this company, and I gave you the reasoning of why this company is still a very high quality company, why I actually bought this company in the first place. As I mentioned basically this whole video, this company has so many positives going for it. It has a strong moat, it has good management, and the price ratios, although are high, it still is a very high quality business. So why did I sell this company? So it all comes down to a few basic fundamentals. First of all, the revenue has been slowing down significantly, and this is something that is a bit of a problem, especially when the valuation is at one of its highest points and the revenue is slowing down. It becomes a bit of a situation where, similar to Apple, the revenue slows down, the valuation goes up, and I just don't see as much opportunity in this business as I used to. If you look at the revenue over the past 10 years, you can see that the compound annual growth has actually been around 6 to 7%. And unless Berkshire could find some significant growth drivers or invest in some new businesses that are growing extremely fast, I don't see this compound annual growth in revenue significantly increasing over time. This company is getting to a point where it's such a big company and there's just limited investment opportunities. Berkshire can't go out and invest in a company with a market cap of $10 billion with their $350 billion cash pile. It's just not possible. So what happens is you're left with a company that's extremely big, the growth is slowing down, and the valuation is going up. For that reason, I have just sold out of this company because I thought there was better opportunity elsewhere. There's always the argument of Berkshire as a conservative position, and I should have kept Berkshire in my portfolio because if there's a drawdown, it will protect me. My counterpoint is that I already own Markel Group as around a 10% position in my portfolio. So I already have 10% of my portfolio in a business that's growing faster than Berkshire, and that's even labeled a mini Berkshire because it has a $24 billion market cap and it's growing faster than Berkshire, and it does basically the same thing as Berkshire. It's an insurance group business that has ventures, and Markel Group does invest their float just as Berkshire does. So I have arguably a company better positioned for growth as my conservative position, and I feel like Berkshire was just not necessary to continue holding. The company I replaced Berkshire with is called Melly, and this is a fintech company. I actually talked about this company in a previous video. This is a fintech and e-commerce business in Latin America. They're the leaders in their sector in Latin America, and it's in a geographic region that is expanding, and as a result, this company is growing at almost 40% a year. I just saw such better opportunity in this business than I saw in Berkshire Hathaway. Now, I'm going to do a full in-depth analysis on this business and explain why exactly I bought this in a different video, but just to give a bit of a summary on why I bought this business, it basically meets all the characteristics of a compounding machine. As you guys know, I love to own compounding machines. I love to own the highest quality businesses on the market, and Melly is an example of one of the highest quality businesses. So instead of having a company like Berkshire where the growth is slowing down and the valuation is going up, I prefer to own a company like Melly. And this company here, I have the revenues pulled up, and you can see that this company is in its phase where it's growing exponentially, and they're reinvesting their capital to grow, and there's a bunch of tailwinds benefiting this company. Unlike Berkshire, who has a bunch of headwinds in the way where they need to find new growth drivers and they need to find new revenue streams, Melly actually has a bunch of tailwinds benefiting it. So you have the e-commerce sector in Latin America growing exponentially. You have fintech and online banking becoming a new thing in Latin America, and all of these sectors just significantly benefit Melly over the long term. And for that reason, I just saw so much opportunity in this business compared to a slower growth Berkshire Hathaway. And obviously this comparison to Berkshire is a bit of apples to oranges because they're not in the same sector and they don't do the same thing at all. But as an investor, I always look for the best opportunity. And it's the reason why I've outperformed significantly over the past few years. I always looked for the best businesses in the best sectors. And to me, even though I'm paying a slightly higher valuation for Melly, I still believe that Melly will have significantly more growth over the next few years than Berkshire Hathaway would. That's part of being a good investor. You don't get emotionally attached to companies. You always look for the best opportunity on the market. And someone like me who only owns 9 companies in their portfolio, I have to be very strict on the characteristics my companies need to have to actually be in my portfolio in the first place. So I saw that Berkshire was just not providing as much opportunity as there was out there. Now, does this mean Berkshire is a bad company and you should all sell Berkshire because I think it's going to go to zero? Absolutely not. I think Berkshire is a very good company. It has a strong moat and it's a very good defensive stock. If you want to have protection from downturns, you should definitely own Berkshire Hathaway. I just saw better opportunity elsewhere, and I'm just sharing this as an update on what's going on with my portfolio. I'm planning on making a video of all my holdings and my portfolio down the line. I hope this provided a bit of insight on why I sold Berkshire Hathaway.